Hello and welcome to Real Asset Media. My name is James Wallace. Today I'm here with Tom Leahy of Real Capital Analytics to talk about the Q1 real estate investment numbers.
So the Q1 data was actually relatively unchanged. Investment volumes were up by 7% in comparison with Q1 last year. Plenty of markets saw growth. I think 7 of the top 10 countries saw an increase in investment volumes. Germany remained the number one market in Europe. Investment was up in Germany. Comparison with Q1 last year. So broadly, the market on a sort of overall level actually looks relatively unaffected. And if you'd sort of fallen asleep in January and woken up now, you'd think nothing had changed. We can look at higher frequency data points to see where some of the differences are emerging. So certainly the number of deals that completed in March was low. It's around half the level we'd expect. If you look at previous March deal counts, it's around half that level. And the number of deals overall in the quarter was actually down. But the reason volumes were up was because we saw more larger deals complete. So we saw a drop off in the count of smaller deals, an increase in 100 million plus transactions.
It's perhaps a bit of a surprise that it was the larger deals where there's greater, if you like, economic risk. That those are the ones that were more robust and actually propped up the fairly sort of strong quarterly numbers.
I think there's probably a couple of points to make there. First of all, there was a lot of momentum in the market as we came into Q1. So 2019 was the best year ever for deals and deal volume in Europe. Q4 2019 was also the best ever quarter. So there's still a lot of capital in the market, and there's a lot of dry powder sitting out there. So there has been a thirst for large transactions and for people to increase their footprint in the market. And it takes around 5 to 6 months to sell a building from when we track. If a building is announced, the owner is selling it, we'll track that date, and then we'll look at when it closed. If you think a lot of these big deals, will have been through a sales process that started in 2019 or the very start of this year, when, to be frank, we weren't really talking a lot about the crisis. There's more momentum behind those large deals. They've been in due diligence for a long time, and perhaps, a little bit more of a drive with more stakeholders as well to get them over the line.
Yeah, and within the deals that did go through, and there's large deals, there was actually quite a lot of shopping centres, and I believe shopping centres in Spain. Now, sort of with the benefit of hindsight, they look sort of probably better for the vendors than the buyers, and you got to wonder if the underwriting on those deals sort of stands up today.
Yeah,
it's not easy to get much of an insight into how much of the pricing of these individual deals has changed at the last minute.
It's very difficult for us to track that. We can track it in some markets where we'll look at an offer price. So sometimes a seller will say we're looking to get, let's say, around £200 million for this building, and then we can track the close price. But that data is relatively thin. We can do it for London and 1 or 2 other markets. So in this case, we don't necessarily know. I think you can probably say in hindsight that anyone who sold a building in the last 6 months was probably selling at the top of the cycle. Yes. So certainly in terms of deal flow, we're clearly not going to see anywhere near the amount of deals this year that we saw last year. It's going to be down quite a long way, and for obvious reasons. And I think for the shopping centres, I mean, the market is not completely uniform in the sense of retail has a kind of a bad rap in the market at the moment, but not all retail properties are created the same, and there are different trends that affect the market. So our data shows there's quite a strong correlation between percentage of retail spending online and where retail property investment is. So in somewhere like the UK, which is the leading edge of online retailing in Europe, property transactions are lowest versus their long-term average. Whereas in somewhere like Spain or Portugal or parts of Central Europe as well, the online retailing numbers are much lower. It's around 5% of the total. And I think that has encouraged investors to be a little bit more optimistic and perhaps a little bit more bullish about the prospects for retailing in those countries versus parts of Northern Europe, where we're clearly much further along that road towards online retailing.
I think at the country level, your report shows that it's Germany that's been the most robust and volumes holding up. Was it more than 50% for Q1, which is quite significantly higher than the average?
Germany's the market that's held up best in April. Now, part of that's to do with there was a very large takeover in the listed sector. But actually, Germany does seem to be emerging slightly from a medical standpoint. They seem to have done slightly better than some other European countries in terms of containing the spread of the infection and a lower death rate. And also, we've seen, I think, more people in Germany are still going into their office and going to work. If you look versus some of the other European countries, at least according to the statistics I've seen.
I think there's a correlation, isn't there, between the severity of lockdown, the severity of public health impact because of the virus, and of course the impact that has had on GDP in those host economies. Yeah. And so the shallower have actually been able to lock down the least and probably open up relatively quicker.
There's certainly some truth to that. And if you look at Italy's public finances, they're going to come out of this crisis in a worse state that they went in. I think one thing to say is, I mean, clearly, having said that, Milan had a very, very strong 2019 and was a real estate market that was very much in demand. But yes, Italy, we've hardly seen any deals in the last couple of months in Italy. And that's for obvious kind of physical reasons, because while the lockdown persists, you can't go and view a building. No one, I don't think anyone who's a serious institutional investor buys a building without having first seen the asset, inspected it, done all the due diligence, on a physical level for the asset. And that's what makes property different and also interesting from an investment.
What do you think about the kind of comparisons that have been made to the global financial crisis?
The IMF have said the best comparison is the Great Depression. The 1920s. So the drop-off in economic output is going to be much, much more severe. And that's, obvious because, we've shut down large parts of the economy. So from a real estate perspective, though, I think the market is in a very different place. So, if you look at the relative value that real estate investors get this time, as we enter 2020 versus what they were getting in 2007-8, you're getting a lot more relative value from your real asset investment than you were previously. In London, we saw a negative yield gap as the market entered prices last time. So the low rate environment is kind of structurally supportive for real estate. I think also the lessons have been learned about leverage. So the market isn't over leveraged, probably in the same way that it was. There's a more diverse pool of lenders in the market as well, which spreads some of the institutional risk, in the way that, most of the lending last time was in the hands of the big banks and they were forced to be bailed out. And that had long-term effects for government financing and economies. And also, the market isn't overbuilt. So, we haven't seen a huge development cycle this time around. But of course, on the flip side of that, the crisis seems to be exposing the weaknesses in parts of the market where you're already seeing some of those shifts taking place, like retail, where the fact that we're seeing this lockdown is exposing all the retailers who are just kind of keeping their heads above water, seeing some of them starting to sing. I saw a headline this morning, Superdrug, who are a well-known UK pharmacy, they're going to be paying only 25% of their rent for the next 3 months. And they're not deferring their rent, they're just saying to their landlords, we're only paying 25%. Now, I guess that's a choice they've made to preserve their preserve cash flow in face of this crisis. But it shifts a lot of the issues, especially on a retail and for hotel owners, onto the landlords, who are then stuck between their lenders, who've obviously got their own criteria and their own regulatory demands to do things like slotting, and then you've got the retailers on the other side. So kind of landlords are slightly being squeezed in the middle at the moment.
One final question, Tom. Could you give us a preview of what you're seeing so far in April?
Yeah, sure. So in terms of the deals that have completed, they're around a third at the moment of the normal level we'd expect in April. So we've got around 200 transactions in our database at the moment. And that's, much, much lower than we'd expect. Investment volumes, quite a long way down, around 50% down in April versus what we'd normally expect. Again, the disconnect between deal flow and deal volume suggests that, again, it's some of the bigger deals that are still completing. We've seen that, again, with I referenced earlier, there was a listed takeover in Germany that completed. We've seen some other big deals happen, one notably in Copenhagen. But, the market looks really quite, pretty slow. In terms of where the deals are taking place, more than half is in Germany. And a significant number of the biggest buyers in April are also German institutions as well.
Tom, thank you very much for your time.
No worries. Thanks very much. Cheers, James.